All right, let's stay on the markets here and talk a little bit more about everything happening these days. David Bailin joins us now. He's the Chief Investment Officer over at Citi Private Bank. David, great to talk with you. Um, let's talk this morning about kind of how you guys are seeing things ahead of this Fed decision, and a lot of the trends that we've been talking about. Higher rates certainly seems to be top of mind on the program. What kind of conversations are you having there with your clients?
Sure. Well, I mean, first of all, these are the most important topics. So we're coming out of a very unusual time. We've never been through a pandemic before, right? We've never actually come out of a time when there's been this much stimulus applied to the economy, all with good intentions, really, except for the period around World War II when we were funding, a world war for 4 years, almost 4 years. So with this much stimulus, right, we're going to have this incredible burst of economic activity that takes place really over the next year, starting, probably now with the stimulus checks being issued, but extending out over the next year. And you've seen projections from the Citi Private Bank and from all of our competitors about growth rates of 6-7% for a time. And that's engendered two concerns. One is inflation, right? Will there be inflation? And we think that there will be inflation, but it'll be in different areas of the market and not general. And it will not necessarily be sustainable unless that inflation is pumped up by more fiscal stimulus. And the second thing is we're seeing an extraordinarily different economic policy and interest rate policy in the US than in Europe and in Japan, meaning that the Europeans have said, hey, we can't tolerate rates being higher for, let's say, our 5 and 10-year securities, where in the US we're seeing the steepening of the yield curve, while not being encouraged necessarily, we're seeing it actually take place as a part of policy. Now, here's why this matters and actually is a good news for the United States, which is that when our curve goes up and the European curve or the Japanese curve stays flat, it creates an ability for a Japanese or European investor to hedge, to make an investment in the US bond market and hedge it into their currency, meaning that our ability to fund our deficit for the next couple of years could be sustained by that difference in policy. And so with this normalization, which is what the Fed is doing and the Europeans and Japanese aren't, with this actual normalization, that is going to be, I think, the thing that markets are going to have to adapt to here. And in general, that is a good thing for the U.S. to have an ability to attract capital into the bond market to pay real yields as opposed to negative yields. And that ultimately, that normalization, I think, could be good for the economy and, frankly, good for the equity markets, although the transition is incredibly volatile. And that's what you were just pointing out. That's where we are right now. So a little bit long-winded, but that's actually what we think is going on.
David, some chatter on the street this week that a 2% level on the 10-year would bring a market correction. Would you subscribe to that?
I would in some ways, but not generally. And let me describe that. This rotation from, let's say, technology to cyclicals, which is part of our switch right now, is in part a revaluation of high growth stocks, right? It's something to do with what you talked about with SPACs. In order to believe that these companies are worth something, right, you got to go out 5 or 10 years and then discount back their earnings or their cash flow, right? You can't discount back their revenues. You have to actually have that. And so when rates go from 1% to 2%, that discount rate is a significant change and significantly changes the value of technology shares that have yet to generate income. So that's what's happening on that side of the market. And there are some companies, that are going to continue to be able to generate the growth and earnings that markets need to see, but others that will not. So that's, I think, the transition we're in. And so then in terms of our real level of concern, let me just bring you back to December of 2019. At that moment in time, rates were 1.9% before this pandemic really was even on the radar. So the idea of having a 2% 10-year, ultimately, can the market digest that? Absolutely. We can even imagine a normalized rate of 2.5% on a 10-year if we were to go out to 2022, as an example. There should be, we hope, a yield curve, right, and a normalization. I would remind everyone that for 7 years in the last decade, we had rates, short-term rates pinned to near zero. So we just have to get from here to there, right? And then we have to see economic growth continue. Now, remember, we're expecting, right, for the next 3 years, right, economic growth to be above the level that it was, at December of 19, because we're in a new economic cycle now, right? We're post the pandemic recession. And so we have to really take that into account.
So, David, bottom line, if you're an investor, where do you go in this market for the most growth over the next 1 year, or if you're looking at a 3-year time horizon of that economic expansion during that period?
So first of all, in the environment that we just talked about, right, bonds are not going to be your friend, right, for the next 12 to 18 months till we have some kind of normalization. They're going to be a way to lose money. And in the case of the most expensive bonds, potentially, just an example, if you had a long duration bond, a 20-year bond from January 1 till now, you've probably lost 12% in value on that bond on a mark-to-market basis. So number one, we have to be more equity oriented. Two, we have to think about where value is, right? Now, at some point, there's going to be value in the growth markets, right, in the technology markets, but it doesn't exist yet. But there are plenty of places in mid caps, plenty of places in Europe, plenty of places in Brazil and Mexico and in Southeast Asia where a global portfolio can find reasonably priced stocks. In the US, for example, you can find them in healthcare. You can find them in certain dividend growers, right, which I think are still relatively fairly valued. And of course, in the longer term, one can imagine, although price earnings ratios will come down, the market could certainly sustain a high teens and or even 20%, 20 PE for a period of time. That's happened many times in the past. So you want to have an equity-oriented portfolio. You want to have global diversification. You want to have sector diversification. And you definitely want to be wary of very, very expensive growth stocks now in your portfolio that may not be able to sustain their story over the next 5 years because they're going to need to.
David, we're talking about very sensible things, diversification, opportunities, geographic, but I know that your clients are coming in. They're like, hey, crypto, Dogecoin, I got questions about all this stuff. How do you talk through questions that I'm sure you guys are getting about, the fun stuff that's going on in the market these days that, probably isn't a long-term thing, but it's a great water cooler conversation, which I guess is now just a casual Zoom call maybe. Right,
it probably is a goal. But to your point on Bitcoin, there's no, like I tell people, there's no doubt that I think Bitcoin is going to do well because of the level of interest that's coming from everyone about it, which scares me, on a fundamental basis. But at Citi Private Bank and at Citi Global Wealth now, we are really focused on this concept of core and opportunistic investing. And so we want the core, right, to be fundamental, investing 85% or more of one's portfolio in a traditional portfolio. And in the opportunistic side, you can, if you want, have an exposure to Bitcoin or whatever. I think it's very important that everyone listening realize that to get that exposure to Bitcoin, if you don't own the actual Bitcoin, any of these funds or structures can be very, very inefficient way to do that. And so you have to take a look at how you do it. Right now, I'm thinking about how we might do a total return swap or something where you're actually able to invest in the price appreciation of the actual digital currency. I think that probably is the most efficient way to do it. But right next to that, opportunistically, and this is really important, is that we are at a situation now where there are unstoppable trends taking place that I think, although they're fully valued, have an incredible acceleration. The use of data, and where that can be used to both modernize the way things are done, but the actual value of that data. This whole new creation of satellite networks that are going on around the world, and to change how we actually do communications or do the internet. All of this areas of solar, right, which we're talking about. Everyone talks about electric vehicles, but really what's going on right now is that the cost of a unit of energy is below natural gas and oil on an unsubsidized basis. What set of opportunities does that create? And what does the whole world's focus on climate change, which is essential, create? These kinds of giant unstoppable trends, as we call them, are really wonderful investment opportunities that are probably in the long term, or I said, in my view, definitely in the long term, way better than Bitcoin, right? Because you can identify them, you can quantify them, you can find companies that are engaged in them, and you can see that the size of the market we're talking about is extraordinary, right? And there'll be a fight someday between electrification and hydrogen, right? Which we can see coming on the energy front. All of this, I think, creates the kind of opportunities that are so exciting for investors. And yes, they are risky and they are opportunistic, but they are investable. And to what your points earlier was on these companies, you can actually see companies that are building the technologies and actually delivering them in a very real way to markets. So you can look at Bitcoin, that's fine. It could turn out to be the greatest thing ever. But we're going to have to see fundamental reasons why that I think are better for opportunistic investing more broadly.
All right, David Bailin, Chief Investment Officer at Citi Private Bank. David, I appreciate the time this morning. I know we'll be in touch soon.
You bet.